Hello, hello everyone. Welcome, welcome. Hey Andrew, hey Victor, Charlotte. Hi, thanks Darren for joining us. Appreciate
You're
it.
welcome.
Welcome Matt. Always good to connect. And yeah, today we just want to discuss what's happening with the UK housing market, keep everybody up to speed. Many investors are hesitating now, especially over the summer. I think it's been a bit of a quiet period the last couple of months. So what we wanted to talk to today is why investors are hesitating. But often what I find is right now when it's more of a buyer-friendly market, it's actually a good time to invest. As Warren Buffett says, when everyone has fear, invest. When they are not fearful and everyone's investing, don't invest. So I see an opportunity here. A quick introduction. Obviously, myself, Dale Anderson. I've been with Fabric Property Group now for the last 5, 6 years and helped build the UK property division, new build off plan. We are very diligent. We have a very thorough due diligence process in place, which we'll go through. But a quick introduction, Darren, to yourself and what you do with International Property Finance Group.
Yeah, mortgage advisor in the UK, based in the UK. Been a mortgage advisor for the last 26 years, hence the grey beard, not like you young boys. So I've seen most scenarios. IFPG are a bespoke sort of solutions-based brokerage, so we love the stuff that's weird and wonderful. We do like obviously the vanilla mortgages, but with the way the market is and the situation at the moment, yeah, everyone's got a story, so we love those type of things. So yeah, that's what we do within the company.
Brilliant. So Matt's my group director. I partnered with him a number of years ago, and Steve Jacob. I'm based in Cape Town, in fact. I had enough of the rat race. I was in London for 16 years. So I'm quite lucky to be with my family in Cape Town. But I lived in London for 16 years. I got into real estate. I moved there when I was 20, literally had like £100 to my name. And I was like, how can I make money? Got into real estate investment, built a bit of a portfolio, and I was there for 16 years. And for me and my family, it's done quite well for us. I've bought property in all countries like Brazil, Philippines, try to diversify, but the UK has always been very stable. Matt, do you want to introduce Fabric Property Group and what we do, and maybe just a bit of background from the UK side?
Yeah, thanks, Dal, and hi everybody. Yeah, nice to be here. So, Fabric Property Group was set up back in 2014. I co-founded it with our CEO, Steve Jacob, and since then we've been helping clients build their property portfolio in the UK, all parts of the UK market, whether it be secondary, new build, commercial. We've been involved in all spaces. We're also investors ourselves, which I think is a really important thing to mention. We know what it's like for our clients when they're buying, doing the due diligence. We've bought ourselves, active still in the market, have a portfolio of over 50 properties ourselves. So we know how to navigate risk. I think that's quite a key thing to mention. Risk is management of risk in any investment is probably one of the most important factors. So we know how to manage that and really minimize that for our clients. And then also on the sweating of the asset and optimizing the return, we're really well versed in navigating the market and getting the best returns for our clients. So that's where we sit in a nutshell. Whole of market property consultancy, helping clients build their property in the UK.
Thanks, Matt. So obviously, there's been a lot in the news and everything going on in America today. Shocking. I just want to say rest in peace, Charlie Kirk. And these things are ongoing. There's geopolitical factors, but what I do like about the UK is the rule of law. It is quite safe, and consistently there has been an undersupply of housing. So for me, why join Fabric? I've got Matt there, I've got Steve, I've got a team of experts who can source properties. And we have won already in the last 5 years, most trusted property investment advisors in 2024, as well as UK Business Awards. So we're trusted. We've got over 200 five-star reviews. And I think that's one of our strengths. We don't just focus on off-plan and new build. We do acquisitions, sourcing of HMOs, because not one size shoe fits all for investors. Some investors are looking for different things. We work with family offices. So Matt, so what do you see as Fabric's biggest strength in guiding investors through today's market? Are you still there?
Sorry, Dad, did you say something?
Yeah, I just said, what's been your sort of in terms of investors hesitating right now,
Mm.
what's been your opinion on the current market on the ground in the UK? What are your
Yes.
thoughts?
So I think it's a really interesting time at the moment where there's, some bad press in the media. There's UK's not getting the most shine, if you like, but that is really where we see massive opportunity. I think, Warren Buffett says it best. When other people are maybe fearful of entering into a market, that's when you should be buying. So we see it exactly the same. Obviously there's been legislation change recently with stamp duty. I think we covered it in one of our previous webinars where there was a huge uptake from sort of January to April in the market to get deals done before the deadline. And there was a huge softening of the market thereafter in terms of transactions completed. And I think I see Darren nodding there. We all saw it in the property space. There was a real sort of slowdown of transactions. Whilst the new normal was, being sort of found in the market. And, one of the things that I think we'll talk about this, I guess, a bit later, is that there is ways of navigating this, in terms of one thing that we always advise our clients is, yes, okay, there's been an increase in stamp duty, but, you can then look at maybe reducing your offer to then counter that. And, sadly, we see that as a bit of a seller's tax. But right now, because of these changes, it's much more of a buyer's market in the way that there's better deals available for people that are willing to enter the market now. And that's what we're advising our clients on. Entry points now, you're not going to get much better time to negotiate good terms with sellers, developers, etc. So we see it as a really big opportunity when there's a bit of uncertainty in the market. That's a great time to enter.
Exactly. So I'm going to share the screen now. I just want to have a quick introduction with everybody. Let me just put this on.
Yeah, thank you, Dal.
Full screen. There we go. So, reason investors are missing a fantastic buying window opportunity right now. So, sellers market's always heated. Developers ask for high prices. What I've seen the last couple of months, even though interest rates are coming down and inflation stabilized, the market's been a little bit slow. I don't know if it's summer or everyone's on holiday, but what I'm finding is we are able to offer better deals to clients. So today's agenda about a bit about Fabric, the window of opportunity, the UK house price outlook based on the latest data from Savills and JLL and other leading data providers, and then mortgage interest rates, our due diligence process, which I believe is probably one of the most thorough in the market, and then a couple of other extra incentives. Those who stay on will get access to discounted opportunities and our private client desk where you can have a Zoom call with me or Matt or Darren to discuss mortgages and your investment portfolio. So just to recap, we've got 20 years track record experience. I've been in the market 20 years. I've invested in property myself across the UK and other emerging markets. UK has definitely done a lot better for me. I bought apartments 2015, 2016, around 200,000, sold them for £300,000, cash flow positive because interest rates are low. We have offices in London and Cape Town, but we also have a reach and affiliate network in Turkey. We've got very good partners there, Charles Carrigan Novella, Remax we're working with now, and then also Sable International, who are a wealth management company, are working closely with us in South Africa because they trust us and they trust our processes. So we specialize in buy-to-let and regeneration-led investments. We look at the data, and we've got clients from over 40 countries. Darren, do you want to maybe talk a bit about IPFG as a finance group and what you guys do for not just UK buyers, but overseas buy-to-let investors?
Yeah, of course I can. Yeah, thank you. Um, yes, obviously I mentioned that I've personally got 26 years being a mortgage broker, but IPFG have been going for a fair amount of years. I think between myself and my colleagues, there's over 50 years worth of experience. But we we don't just do mortgages for UK clients, as Dale mentioned. We deal with international clients, expats, wherever they are. We'll always try and find options for those. So, but we don't just use the normal high street run of the mill lenders. We can go out to private wealth institutions, commercial lenders. Dale, you mentioned obviously family offices and complex finances, but it's not just a case of looking at the UK domestic market. We can do UK buy-to-lets, we can do UK residentials. If you're thinking of coming to the UK to live, which certain people do, we can do that. We do not just UK expats and foreign investors doing the residential, but the buy-to-lets. We can do bridging loans, commercial loans, development loans, asset and invoice loans, which is something that we've been working on for quite a while. We don't just work in the UK market. So we deal with Portugal, Germany, Australia, Spain, and America as well. So we sort of try and sort of cover all bases really. So if
Brilliant.
you are a client that's looking to refinance something in the UK, which we find a lot of at the moment, people have already got a property in the UK, but don't know how to take the equity of that property to start building the portfolio. We can really hone down on that to say, well, actually, let's maximize that one, use that property to buy the next one and then the next one. So that's where we look. Again, that's the bespoke side of things. We don't just look at what's being put in front of us. We look at the bigger picture of the client.
So you're not just with the High Street Bank, Barclays, you look at
No.
clients from Turkey. I've seen you guys have been at some events in Turkey's,
Yeah. Yeah.
international markets. Something a lot of overseas clients don't know is you can get mortgages as a
Mhm.
non-resident,
Yeah.
and interest rates are starting to come down, which compared to these emerging markets where you pay 10, 11% interest, like
Mhm.
South Africa, you can get
Yeah.
interest now. What in Turkey? What kind of interest rates, or um, what's the current
Yeah.
criteria?
Okay, so every country will have different criteria, different lenders. But yeah, like you said, we deal with lots of lenders that specialize in international and expat clients wherever they are globally. We deal with some offshore wealth banks as well in the Channel Islands, so they look a little bit more flexible. So they offer a bit more of a personal service, if that makes sense, as opposed to the big banks and building societies. But it's still giving an overview. Obviously, you've not talked about properties and stuff, but I'll give you an overview of a couple of those countries that you obviously mentioned, like South Africa, for instance, because you're there. Um, Loan to values, you're talking between 65 and 75% loan to value for international clients and expats. And if the minimal loan is say 200,000 for South Africa, we can get a rate of 5.5%, which is fantastic because it's only just a little bit more than you'd get if you're actually buying in the UK. Clients are obviously mentioned in Turkey. There are some lenders that will do up to 80%, which is very unusual. We've got a lender that we've been working with for quite a long time that they want to open up Turkey. So we've sort of helped them build a product. But you're talking about 6% for Turkey. And if
Okay.
they're based in the UAE, maximum loans around about between 60 and 75, but you're talking between 4.5% and 5% for if you're based in the UAE. So that gives you sort of a quick overview.
Brilliant, because I'm looking at some stuff here in Cape Town and I can get a mortgage, but my mortgage is 9, 10%. So then what happens is it's all good, but your rental income goes into the interest and you're cash negative. The UK is cash positive in most cases, especially when interest rates come down. So it's good to know we can help overseas buyers. So that's great. So we wanted to discuss the objections or the three reasons why investors are currently maybe skeptical or holding back. Currently, we deal with clients from 40 different countries. We've got obviously in London, Cape Town, but we have a base in Turkey, Middle East. We've got a number of affiliates, and we welcome people to join us as affiliates. We can white label and help support their business to attract clients. But just to go into the window of opportunity, now I've been telling everybody, okay, market's been a bit slow, summer holidays, but what they're not looking at is we were in a seller's market. Prices are stabilizing after the correction during COVID. Inflation was very high, 10, 15, 20%, which is crazy. That's now stabilized in the UK, well below 10%, 3%. So interest rates are coming down. And that's really the window of opportunity there. So, um, Matt, in your opinion, what is the reason people are holding back right now, and why do you think now is actually a good time for investors to look at the UK market?
Yeah, it's a good question. And I alluded to some of this earlier with the legislation changes, one of them being tax for stamp duty. That one actually did come into play in April. So that was, quite a big jump in stamp duty. But I think people understanding actually how to navigate that is important. There's a couple of ways that you can mitigate stamp duty. One is to simply offer less, quite a simple concept, but, put that tax onto the seller. That may not be accepted. However, from what we're seeing in the market right now, sellers are at their most sort of persuadable, let's put it, to
Motivated.
motivated sellers. And we're seeing that across the market. People want to see traction. So that gives some angle there, and people offer incentives for sales and the such like. That's one way. Another way in the secondary market is to look for a property which is mixed use. That would then qualify you for something that's called non-residential stamp duty, which is cheaper than a residential rate. And again, we can talk about this if you want to talk about on a one-to-one basis. Dale will give you opportunity to book a call in. We can talk in more detail. Or if there's a property, whether it be residential or commercial, mixed use, etc., where it's in an SPV, you can actually buy the shares of that SPV company, and the stamp duty rate for that is 0.5% of the purchase of the company. So there's ways you can mitigate stamp duty. So that's one way. Those three there is the stamp duty aspect of why people might be holding back, just not knowing how to navigate that. That's what we do for our clients, help with the strategy, help with the solution. So that's one thing. Other things, uncertainty. I'd say, the renters reform bill coming in, understanding actually what does that mean for them as a landlord, and also things like national insurance maybe being, bouted about. There are simple solutions to these things. National insurance, for example, if you're buying in a UK limited company, that wouldn't affect you. Of course, I have to say this all with a caveat that we're not tax advisors, but we can obviously give high level information and direct you to the right advisors. We've got a panel of recommended team, Darren being one of them, in terms of mortgage and finance, but we've got, a whole host of solicitors, accountants, etc., that we can help you with. So yeah, those are the key things that I'd say people are, seeing a little bit of hesitation by, but there is solution. There is, things you can do to mitigate against them and obviously move forward and take advantage of, the seller motivation.
Gotcha. And if you look at stamp duty tax across Europe, the UK, unless you're buying in London, it's not a huge amount. It's like 3 to 5%, but over a certain percentage, right, Matt? So what you need to think of, you've got your one-off entry cost of stamp duty, but then you've got ground sort of growth and rent compounds for years. Rents are up 5.9% year on year, according to the Office of National Statistics. And Savills project 24.5% UK growth between 2025 and 2029. In the Northwest, 31% growth. So yes, there's a little bit of stamp duty tax there under Labour government, who we know want to tax landlords, even though Angela Rayner's now dodged tax and taught us a loophole and been fired. So that might change. The political landscape is ever evolving. But you have rule of law, you have hard currency, is my opinion, as good as gold. It's a very stable currency, inflation stabilized. So you can wait, but at the moment, rents, there's not enough demand to meet supply in the UK. So we'll go on to that next. If you look at the latest Savills projections, according to Savills, and I've followed them now for probably 10, 15, 20 years, they've been very accurate. The Northwest, you're looking at 31% growth over 5 years. Yorkshire and Humber, 28%, Northeast, 26%. And then London, everyone knows London, especially from a global perspective, but it's very expensive. Yields are quite low. Yes, we do London, but we tend to focus on commutable towns because the reality is professionals like me and Matt, we don't live in central London. You commute. You live in Wimbledon or Kent or Staines upon Thames. So we focus on those areas. We feel there's good value, better yields. But as you can see, Northwest Birmingham, very positive prospects compared to 2 years ago during COVID when interest rates were higher. Looks like prices are going up. So we're data driven. Matt, in terms of politics and rent reform, do you think Labour, and this is a controversial question, and I don't mind putting it at you because we're not judges to solve, we want to educate clients. Do you think Labour will make it harder to be a landlord in the UK? What's your current thoughts on the situation there? Is politics a threat, or are fundamentals stronger than the headlines?
It's it's a really good question, and I do believe that Labour are going to make it tougher to be a landlord. However, I wouldn't say that's necessarily all bad. I mean, there is some negative impact, of course, but with Labour being a bit more of a socialist sort of policy government. But the thing that it will do is weed out the non-professionals, which is a good thing. You want the private rented sector to be more professional, people delivering quality. So I think that will be one of the benefits of it. Rent reform, it looks like it's going to come in. So that will have more tenant pros, in terms of the law. And it'd be harder to evict people. That's just going to be part and parcel of it. So one of the bigger, aspects and focuses will be on the selection of the correct tenants. That then means that, if you look a bit more macro rather than the micro view, buying in the right areas that have the right tenant demographic is going to be an important aspect, which is what we do. We look at all of the, surrounding aspects for any investment, making sure that you've got good tenant demand, good growth in the area. So all of these aspects are going to be really important choosing a property and not just buying what's cheapest on the market, because cheap isn't always the best. Sometimes I think you might hear the saying out there, buy cheap, buy twice. Sometimes be the case. So we're very much about selecting, cherry picking the most quality assets for our clients, because we understand, we want to give the best for our clients.
So reason number 2 holding people back is political and rent reform by Labour, right? Everyone's worried, tax. However, the UK is undersupplied. According to JLL, it was 350,000 homes a year. It's now jumped to 720,000 homes shortfall, and they're only delivering 220,000 homes a year. So it's almost like they're trying to encourage affordability or rent reform, but what that's doing is creating less supply and almost causing a self-fulfilling prophecy of there's not enough houses being built, which is only going to drive rents up, right? In my opinion. What are your thoughts on that, Darren?
You're bang smack on. I think they can't, no government over, if you look over the last 15 years, they've all been saying, we've got to build 350,000 new homes across the UK. And then I think last year, there was 120,000 new homes being built. So how does that doesn't equate to me. So
and that's jumped to 720, so it's doubled.
Yeah. But because they were never going to get to 350. So if they say 720 and they come in with 350, then that makes them look bad. But I'm getting off my soapbox here. But what happens is, because they're not building enough, the reason why they're changing all the rules, whichever government it is in, they're always trying to change the rules and change it on the stamp duty, the taxation. If you go back over the last few years, there's always some changes to try and eliminate the buy to let. But like you said, the professional landlords will sit tight, wait for the dust to settle, and then carry on. Doesn't ever stop.
Mm.
And all it does is it just means that because they're not building enough, the prices of the properties will obviously increase because people
Mm.
can't then rent, so they have to buy. And then suddenly you get the investors again because the people that want to buy can't buy because the rates have come down, the rates have gone up a bit, or the prices of the properties have gone up, so they can't afford to buy it. So then the investors come in and swoop in. So and then the rents.
Yeah.
So it's always been the same, Dale. To be fair, it's always a fantastic time to buy to let, regardless, because and I know you're probably going to come on to this in a second, but with the Bank of England base rate coming down, people are going, well, I'll wait for the Bank of England base rate to come down. But when the Bank of England base rate comes down, then
Yeah, the
property
seller's
prices
market.
go up. It kept become
Correct.
it go up. So actually, it's never. There's no point
There's
in
never a
waiting.
right or
You just
wrong
buy now.
time, right?
No, there's never no.
Yeah.
But they're never going to build enough houses in the UK. We're such a small country, contrary to belief. We're such a small country. The governments are trying to relax the green belt areas where people can buy, so people
Mm.
can build. But if you look at all these areas you're looking in, then there isn't any green.
Mm.
They have to go up. So, and the ones that
Thanks, Dan.
the properties that go up are rentals. Have investors want to buy
Well,
those
it's
properties that go up.
very basic fundamentals. Not enough supply,
Mm,
high demand, and we're not
never
meeting
has.
those expectations. So
No.
rents are going up,
Mhm.
and everybody said during COVID prices are going to crash, and they didn't. So all of that YouTube doomsday news stuff, it's simple supply and demand. We've got to build 720,000 homes a year. They're not delivering. I think Labour will be out at the next election, if I'm honest. And then tax will probably be more friendly, but we'll see what happens. We don't know. So the UK rental market highlights, rents have surged 40% since 2020. So not we're seeing inflation on rent. We're seeing inflation on everything, right? Across the globe, food, oil, gas, everything. But it's a problem for tenants because average rents outside London now are 1365 per calendar month. Um, it's a problem for it's called generation rent. If you're between the age of 18 or 25, you're living in house share or you're renting. Rents are going up. You're only really getting on the property ladder in your 30s, and then UK British people are inspired to buy property and own homes, right? So that's their thing that they want to do. But right now, as far as global politics are concerned, a lot of people are saying, oh, I'm going to invest in Dubai rather, tax free, all of that. Uncertainty drives investors to safe havens, in my opinion. The UK has a transparent legal system. There's a net migration of 431,000 people a year. Okay, you don't have to live there. If you want to go live in Bali or wherever you want to live, that's fine. But London is still the global hub, in my opinion, and I still believe that. Are you seeing overseas clients view UK as a safe haven, Darren, or what kind of client? What are clients saying um, from your perspective who are investing in the UK? Do they see it
I'm
as
probably seeing more at the moment. Lots
more?
more investors, not just for the normal countries, not like the UAEs. I'm actually seeing clients invest in the UK because it is, like I said, secure, heavily regulated. The money's sort of safe, but I'm getting people from Turkey, I'm getting people from Nigeria, I'm getting people from Zimbabwe. So all the countries where potentially I was getting one or two, maybe inquiries a month, I'm now getting four or five. So they're realizing that the UK is definitely a strong market, which is brilliant. And there are options for them.
Yeah. So we're in a bit of a buyer's market. It's a bit slow, but like, is that the right time? Because you can speak to me and Matt, and right now, um, we have the ability to negotiate for a short window the next few months. The other objection, so the objection is global instability makes property too risky right now, right? But surely, what do you invest in during times like this? I mean, the UK is fairly transparent. You've got an income producing hard currency. I think GBP is as safe as gold. Um, Matt, what are you finding on the ground there? Like, what's the biggest challenges you're having to overcome, and what are your thoughts?
Yeah, so I think Darren touched upon this earlier. The UK is seen as a politically stable market, and one of the things that we find a lot is that it's close because it's not part of the EU, but it's very close logistically to the EU. It's seen as quite ideal place to diversify one's portfolio. So we've got a lot. I think you mentioned it earlier. Turkey. We've got a lot of clients from Holland that have done the same. South Africa are the same as well. So I think that's something that's definitely been seen. But in terms of actually things on the ground that we're seeing, it's very much what I said earlier, really, in terms of the legislation changes that have just created a bit of an uncertainty with clients. And it's natural. Any changes can be a bit confusing, but that's why we offer their help. We've got our finger on the pulse of the market. We're constantly talking through these issues and thinking about how to solve them and come out there the other side with the best result for clients. So yeah, that's sort of the things we're coming up against.
So we're in a bit of a buyer market now.
Definitely.
Buyer-friendly market conditions because of the concerns and instability. But in fact, interest rates are coming down, inflation's down, and demand is exceeding supply. So if we look at rental growth forecast, Zoopla latest report, I'm a data guy, so I do a lot of research. I've got a LinkedIn newsletter you can sign up to for free. Rent increases. So whilst prices have been subdued, Manchester rent price coming at 5.8%, London 6.3%, Birmingham 6.9%. So as you can see, there's been rental inflation. There's a net undersupply which keeps upward pressure long term. And I'm seeing a lot of institutional investment now, even BlackRock and big companies investing in places like Leeds. So it's almost like follow the smart money, right? If institutions are buying. Mortgage and interest rate update, Darren. What's happening with the mortgage market and what do you expect to happen in the next 12 months? Are we seeing interest rates? They've come down 4 or 5 times already. Do you see further rate drops?
Yeah, so what we're getting from the banks of Being societies when we're talking to them is they're sort of envisioning, look, the Bank of England base rate has gone from 5.25 down to 4%, but they're sort of saying now that they're predicting the Bank of England base rate by early 2026, so maybe Q1, Q2 next year, down to about 3.5 to 3.75. Obviously, that's depending on sort of inflation, and that'd be the UK domestic market. What happens then is over time, the expat and the international buyers, those lenders that specialise in those type of clients, will start bringing their rates down because expats and international buyer mortgages, some of the lenders aren't linked to the Bank of England. They're back to what the banks borrow money off each other. But obviously, the Bank of England's lower, then obviously the cost of borrowing comes down, and that gets reflected in the rates. But it's definitely going to come down, which it can only be a good thing, really. So, yeah.
So we've had a few interest rate reductions. I pulled out of some of my properties when I saw interest rates going up during COVID, because all of a sudden I'm seeing, okay, I'm getting £1,200 a month. I was paying £500 on my interest. Now it's going to 900. So now I'm worried. We're getting back into a position where it's cash flow positive, right? So you can put 40% in, 60% loan to value, and you're cash positive. Effectively, rich dad, poor dad, your debt is being paid by your tenant, right? And we're getting back into that situation with interest rates. And I think with the current geopolitical situation, interest rates will come down provided inflation's stable. You've got other markets and war going on in certain territories in the world. So where do you invest where you can use the bank's money, leverage the bank's money to make money? That's why the UK makes sense to me. So I've gone to the next slide, due diligence. Matt, something we're very passionate about.
Yes.
Part of my job is I've been burnt. I'll be honest. I've had developments in the past as a younger man and naive where I've gone in blind, I've sold flashy buildings. There's a few things you got to check. Are the developments fully funded? Who are the directors? What's the reputation of the developer? So we check these things. We have a very thorough 100-point checklist for due diligence and deal sourcing. And that's to not only protect our clients, protect our reputation. So we've made some mistakes in the past, we've learned, but we make sure we get proof of funding to make sure the projects will get built. There's deposit protection, but also we're not tied to any one developer. A lot of agents out there, they're exclusive agents. So they are tied and under pressure to sell that developer stock. Matt, what makes Fabric different?
Yes, so this you're absolutely right. We are very passionate about this point. You know, we're very, very picky on what projects that we work on. So we have a very thorough due diligence process. I think I mentioned it right at the top of the call. We are investors ourselves first and foremost, so we know what it's like to be the investor. So we take everything we work on like we're going to be buying it ourselves. So there's lots of things that we check, you know, from funding of a development to track record of a developer. We do financial appraisals, stress testing. So we'll talk to people like Darren, and, you know, stress test the interest rates and, you know, see what's live in the market at that point. On top of that, you know, we'll look at what's the best way of structuring the property purchase. So, you know, taking tax advice, looking at stamp duty, you know, optimization. So everything that we can possibly do to make the transaction lowest risk possible for the highest return for our client is what we endeavor to do. And also keeping a pulse on, you know, the market changes that are happening so we can best advise as well going forward.
Thanks, Matt. And I'm going to be very transparent. I've done this, as I said, almost 20 years now. You have these products on the market that will say they will give you 10, 20, 25-year guaranteed rent. They'll give you a 10% guarantee. Number one, it's not a guarantee, it's an assurance. An assurance is a promise or contractual assurance by an SPV, special purpose vehicle. Number two, this is often on social housing student accommodation. I'm not saying it's all bad. There's some really good student accommodation near the universities that deliver. But there's a lot of opportunists out there that will sell you something. Okay, great. We'll give you 9, 10% fully managed. But if you dig beneath the engine of the car and you look at the fundamentals, it can be built in the price. It's not a government contract, it's with a social housing provider. What are the key risks you would say, Matt, to look out for when investing, not just new build off plan, but you know, some of these so-called guaranteed schemes with these huge promises of rental guarantees as such?
Yeah, I think trying to keep it simple first and foremost would be the first thing. If it's too good, if it sounds too good to be true, then it probably is. I think is always the cautionary tale. So, you know, we see these ones in the marketplace of 10, 25-year government-backed leases, for example, just using one of those, not naming any names, but that's one.
Yeah, some of them are not that bad, but let's be honest.
Yeah, some do, but so anyway, we look at those and, you know, you look under the hood and they're maybe not quite as they seem. So, you know, that using that as your first sort of point of sort of you know, caution would be around, you know, if something's too good to be true, why is that? There might be something in there. I think taking a bit of advice is always important. You know, always take legal advice, always get second opinion on property. I think if somebody's claiming something in an investment, always make sure they can verify that with data. That's something that we're very passionate about. I know you've banged that into the team, Dal. You know, data driven. You know, property investing is how you have to look at things. Proven, not guesswork. So yeah, I would say they're the key things. Is you know, looking for things with track record, and not, you know, something that is a real shiny object that looks like the perfect investment when actually it may not be as good as it first of all seemed.
Well, this is it. I mean, we're all driven by wanting to plan for retirement for our children, our families, and make good investment decisions. But if something sounds too good to be true, please send it to me and Matt, and we'll do a free feasibility study on it for you and due diligence, because you might rather buy something that's going to give you a 5 or 6% yield, good capital growth, you bought at the right price, it's residential, than buying with some alternative investment. And I've seen it time and time again on PBSA, commercial, social housing. I'm not bad mouthing anyone. One must be very careful. There are good government leased social housing schemes out there, but there's a lot of opportunists right now. So just a word of warning. So yeah, really the main objections, stamp duty, we've covered. It is what it is. It may come down. We'll see what happens. It's not a huge cost. I've seen markets where they charge a lot more than your 5% stamp duty tax. Political and rent reform, fundamentally, there's an undersupply of 720,000 homes a year. They're only making the situation worse. Global instability in certain other countries, South Africa, Turkey, wherever it is, Qatar, there was rockets flying the other day and all kinds of things going on in the world. So the UK is still a safe haven. Pound is a great currency to earn. It's very stable, and it's one of the most historic currencies, one of the most historic frameworks. And you've got a net migration of 431,000 people a year that need property to live in. We focus on young professionals, business districts, universities, Manchester, Liverpool, Birmingham, commuter belt London, Leeds, Sheffield. That's our core. If you want something a bit cheaper, there are some certain pockets of opportunity in Blackpool, Preston, Hull. That's kind of what we cover. We look at the whole of the market, and then we choose what we believe we would invest in and make sense. So on to the next point, free attendee resource. We've got our free 2025 buy-to-let guide. I'm living in the past. It's got the latest data from Savills, JLL. We use AI data-driven strategies now as well. It's something I'm quite passionate about. So we will provide you with the free link to the latest free guide. And then also exclusive for attendees bonus, £1,000 voucher towards your next UK property purchase, valid until 30 September 2025. At the end of the day, we're always open to discuss and educate our clients. We're in it for the long term. We don't want to rush clients, but we do believe there's a buyer's window opportunity. So you can scan the code there. If you want to book a consultation with Darren, please do put in the questions box. I've been told by my IT team now. Make sure ask the questions are sent directly to the person. So Matt, Dale, or Darren directly when you get to Q&A. Also, Darren said social housing nearly impossible to get a mortgage, so that's also not guaranteed. Is there anything else, Matt, you want to add to that, or before we leave off, or any questions? Please drop them in the questions box. For me, Matt, we're happy to have a consultation. We've got a private client desk where if you are looking to invest and build a portfolio for retirement, me and Matt will speak to you directly, jump on a Zoom. So put it in the Dropbox in the comments, yes. If you would like a free consultation with me or Matt, just put yes, consultation. If you want the free guide, just put in free guide. And if you want a mortgage consultation with with Darren to discuss remortgage or refinance, it's a long day. I've got 20.
That's going to be an interesting one, Matt.
Yeah. I think they'll be coming your way.
Just put your questions in the comments. Normally, we've got all the questions coming in one comment box, but please do throw your questions in there, and then we'll do a quick Q&A.
Yeah, Dale. So just on that, you mentioned about if I had anything to add, I think the key sort of takeaway from my side is yes, okay, there is changes in the market. There's always going to be changes in the market, no matter what government's in. I think Darren touched upon this earlier, but just knowing that there is support there, we are active in the market, so we are here to help. There's no such thing as a silly question, so always feel free, pick up the phone. It's free consultation and support, and we're here to sort of help you to dispel any sort of confusion or any kind of thing you might need. So yeah, always feel free, come forward, and we're happy to help.
Great. If you just scan the code there, we can put you in touch with Darren. It's not going to cost you anything. Darren will give you a consultation on mortgages and interest rates. Me and Matt will jump on a call to assess your current goals, requirements. We're not tied to any one developer or supplier. Our prices are direct from the developers as well. And yeah, we can run you through our due diligence process. So yeah, any questions? Couple coming through here. Let me just check. Few questions, Joe. If you were starting a portfolio today with 100K, where would you invest for the best mix of yield and growth? Maybe throw that to you, Matt.
Yeah, sure. So there is probably a couple of questions I'd ask before giving that answer, but it all depends on where you are in the market. So whether you're based in the UK, whether you're based overseas, because it's not the same size fits all for everybody. Because, you know, if somebody's in the market in the UK and they have access to get to site, I might be suggesting go do an add value strategy where they can be hands-on, add that, you know, but that might not also be possible if they've got a full-time job. So it all depends on the person's circumstance. But I'd say as a general rule of thumb for most people have, you know, full-on jobs. So they're looking for hands-off investment. I would veer towards going to operating property, which are income producing pretty much from day one, or hands off in terms of new build off plan investment, where you can see some really good capital growth in the major cities, in the major regional cities. I would sort of add to that as well. London's great. I think we touched upon that earlier, but the real sort of return of, I think you touched upon, capital growth and yield will be in your key regional cities. And I think you even, one of your slides, Dale, you had that there: Manchester, Liverpool, Birmingham, Sheffield, all the areas with the biggest capital growth forecast and also the rental growth forecast. So again, this is why consultation is so important, because not everything is right for everybody. Everyone has their own individual strategy, their own individual circumstances. But if I did a general answer, that would be it.
Yeah, Darren, just on your point on social housing and the mortgages, what are your thoughts on that stuff?
Okay. So social housing, if it fits the client, obviously that's great. But social housing, we've tried social housing applications with different lenders, and they always seem to get declined. So if you're going to go down a route of social housing, like I said, if it looks too good, it probably is. And the main reason why lenders don't like social housing is because, like you said, it's not guaranteed rent. It's just an assurance that they should pay it. But obviously, what I've found personally over the last sort of 5-10 years is social housing companies being sold to another social housing company, and suddenly you haven't got no guarantee, you've got no assurance then, because the new contract doesn't work. So if you've got the cash and you're happy to take the risk and high reward, then go for it. But there isn't any mortgage companies, unfortunately, that will take it on board. We've even tried a lender that's based in London and Hong Kong, because obviously Hong Kong market is slightly different. They look at that type of stuff, but even they said, unfortunately, we're not going to take it, because the wording sometimes on those rent guarantees are so ambiguous. There's always a way for them to get out of it. So just, I would say, if you're happy for the risk and reward type of thing, then go for it.
Don't be blinded by rent guarantees. It's a contractual promise underwritten by an SPV company, which can be folded when the companies fail. Let's be honest. There are some good providers out there, Circo and that, but you know, a lot of the rental assurances are built into the price. So look at the asset, look what you're getting, look at the demand and the location, and make your decision. You need to think of energy performance ratings, liquidity, and mortgages, because if you've got to sell to cash buyers, you could end up with an asset that you struggle to sell. Another question: would you guys recommend to focus on investing in few smaller properties or one bigger in the UK? Which works better? Maybe Matt?
Sorry, could you repeat the question, Dale? Sorry.
Would you recommend to focus on investing in a few smaller properties or one bigger property?
Yeah.
Like
again,
1 or 2 beds, or a bigger commercial HMO or whatever, Matt?
yeah, I guess it's where you are in your journey. You know, I'd say if you're entering the market, then I'd say, you know, don't overstretch yourself, come into the market with a couple of smaller units, maybe even go with one. You don't have to go with two to start with. It's a really good entry point. You can get to know the legal system, how the process works. If you're a bit more experienced, we act for a lot of experienced investors. We also act for very
blocks,
novice investors as well. Some of our experienced investors are large family offices, 400 million under management. So we've got a real sort of spectrum. So I guess if you're more experienced, look at the bigger stuff. So
that's a good point to cover. So we have new build off-plan division. Start off, test the market, studio 1 or 2 bed. But can you explain the divisions of what we actually do? So we do new build and off-plan, but we also do other divisions. Do you want to just cover that quickly, Matt?
Yeah, touch on it. Yeah, sure. So Dale absolutely rightly said, we are whole of market. We have 3 divisions. We've got the new build and off-plan sector, so completed new build, off-plan new build. We have secondary, which is anything from a small terraced house to HMO, which is where you rent out each of the rooms. It's called a house of multiple occupancy, if you're not familiar. Blocks of apartments, so self-contained apartments within one block on a freehold. Then you've got mixed use. I alluded to this earlier with the stamp duty mitigation. So you've got maybe a commercial unit on the ground floor with uppers being apartments, for example. So the mix of commercial and residential. Also land. So some of our clients are developers, so they're looking to develop land. I wouldn't advise that necessarily for somebody who's overseas looking to enter the UK market. That's a bit more of an advanced strategy, more of what I was saying about an add value hands-on strategy. So we do that. That's the secondary division. That's a lot of what my sort of 15 years in property has been involved in. And then with the third arm, we have a real estate private equity division, which is more about asset management, dealing with commercial properties. So to give you an example of a couple of recent deals we've just done, we've done a retail leisure property deal in Plymouth. I think we bought that one for 2.1 million. The asking price was 4 million. So we did pretty well on that deal. And that's, I guess, having contacts, get the deals. We also are in throes of a office deal at the moment in Leeds for, in the region of about 4 million. So, we've got different aspects of our business. If you want to be owner of a property portfolio, we can help you to build that, in your ownership. If you want to be more of a passive investor and invest in our projects, and we're, in a more of a joint venture style deal, again, we're open. So, like I say,
that's it. Yeah,
is key.
So it's good. We're not just like selling your off-plan and new build, although that's my division. We have these core divisions to help different investors. Passive income, fully managed, new build warranty. That's my thing. I love new build. I love luxury properties, but Matt can help and the team there. I've got a great team on the ground. Another question, what is the best way to leverage equity in the UK? Is it better to try working with local banks and then bring that money to the UK, or use UK institutions? That one's for Darren.
This isn't going to be this is going to be nice and positive way, but so the UK, like I said previously, is heavily regulated. So the banks and building societies in the UK, and also the legal side of things that you mentioned, Dale, earlier, the legal process in the UK is very transparent. So part of the transparency is they need to know where the funds are come from. So, and the lender, when we do the mortgage, they need to know where the deposit money is coming from. So if you're going to use, say, for instance, you take a loan out in South Africa for a deposit to use as a deposit in the UK, then the lenders will decline the application, because technically then you've borrowed 100% of the property value. So I would say
use
try
the
and use
UK bank's money.
but in this question, obviously I don't know who it is, but I think what they're alluding to is, if we borrowed money from wherever we're based, somebody globally, from someone like a bank, and then use that as a deposit, and then use a UK mortgage company for the rest of it for the mortgage, how does that work? But that's, again, you're borrowing 100% of the property, and the lenders in the UK will say sorry. So, because they have to have a paper trail of where the funds come from. So part of the actual application and part of the process that we follow is there's a source of wealth. So we need to know where the money's come from. That could be employment, savings, inheritance, but it can't be borrowed from another institution anywhere globally for the benefit. I'm really sorry that wasn't as
No, no,
sexy
that's
and as
fine,
positive
Darren.
as possible.
Listen,
But yeah,
Darren's been in the market for 20 years and he helps not just UK buyers but international investors with mortgages. We'll send an email out with Darren's details and you can jump on a call because it depends on your situation, your personal
yeah,
circumstances. There's a
yeah,
lot of variables, but ideally you want to look at UK and then we've got the main street lenders and then some of the niche buy-to-let lenders
yes,
for investor-led schemes, but rates are coming
yeah.
down and overseas buyers, we can help unless they are on the red flag list or whatever. One more question, Bogdan. Thank you, Bogdan. I'm an active Fabric client and strongly recommend these guys. That's such a great reference and feedback there. I really appreciate that. He's asked, what would you recommend for an EU-based investor with 270k cash? I'll throw that one your way, Matt. So I don't be biased and say buy a new build off plan.
Yeah,
So
no,
I'll leave that
thanks,
one with
Dale.
you.
Yeah, no, and also thanks to Bogdan. Obviously, I personally know Bogdan. He's one of our guys, Scott's client. So yeah, thanks for the kind words, Bogdan. In terms of the question itself, this comes back down to where the client is on their journey. Obviously, in part of Bogdan's question there, he said an EU-based investor. My recommendation would be to keep to the key regional cities. And I know, Dale, you'll be pleased to hear my recommendation would be to go new build, either completed or off plan in either Liverpool, Manchester, Birmingham, or Sheffield, actually, which we're seeing quite a bit of growth in at the moment.
Great. So Bogdan, you're in touch with Scott, but as directors, we are always available as well to, if you're ever second guessing, we support our team from the top down. So we're happy to speak as well. So yeah, I
I'm going to
think
be
we're running
speaking
out
to
of
Bogdan in a
time.
bit, actually, Matt. So yeah,
Oh, great.
Fantastic.
There we go.
Sheffield, Bogdan, Sheffield. All right, we'll go for Sheffield.
Sheffield. That sounds good. Let me see if there's any more questions and then we're going to cut it off. We don't want to go on too long. We will send out a replay. We'll send out Darren's details and also a link to book a consultation with myself, Matt, or one of our senior consultants. All of our team have 10 years plus experience. I think experience is very important. I don't believe in these trading floors or sales guys just pushing products. We are a service-led company. We help with the mortgage, the tax advice, the structuring, and then we look at what products are going to suit you. So I appreciate everyone's time. Please scan the QR code. You will get the free guide. We'll offer the consultation with Darren. Is there anything else anybody wants to add? The loan amount would be from the EU. He said, thank you. Thanks a lot. Thanks, everybody. I appreciate your time. Matt, Darren, really appreciate it. Thank you, everybody, for your time. Have a good evening. And yeah, we'll send out the replay. Appreciate your time.
Thanks, gents. Thanks,
You're down
everybody.
for inviting me.
Cheers. Thanks, Darren.
Take care,
Cheers,
everyone.
Matt.
Take care.
Bye-bye.
Thank
Bye.
you so much.